Hello, welcome back. Today we're going to focus on chapter 23, which covers the statement of cash flows. This will have two lectures to it. The first one we'll cover the material in the lecture handout packet, and then the second lecture is we will cover a comprehensive example of how to complete the statement of cash flows. There will be additional documents for you to use for that example, including potentially another Word document and also a Excel file with some financial information to assist you in calculating the information that you need to complete the statement of cash flows. So overall, as a brief introduction, for corporate investors and potential investors, they all frequently seek information about a company's financial position, the results of their operations, and their cash flows. This chapter is going to focus on the significance of the statement of cash flows and all aspects of its preparations. The cash flow statement is very, very important for investors, creditors, and other users of the financials, as it provides them the ability to understand the company's ability to generate future cash flows, their ability to meet and pay dividends and obligations, the reason why the company's net income does not equal the net cash flow from the company, and then the cash and non-cash investing and financing transactions during the period. This required presentation provides the financial statement users with information about the major sources and uses of cash during the fiscal period. If you have not heard this before, one thing that is frequently taught, at least in finance courses, is that cash is king. So a lot of investors would rather know how the company is using their cash as opposed to how much income the company is making. However, please note that income is also probably the primary driver of stock changes and how the companies are valued. However, from an analysis perspective, knowing if the company is going to be able to meet certain obligations such as dividends or debt payments is important, and to do that the company needs cash to make those payments. So having an understanding of how much cash they have is significant when you're looking at potentially investing in a company. So the purpose and use for the statement of cash flow. First, the purpose is to provide information about the cash receipts, which is the cash into the company, and the cash payments, which is the cash out of the company during a certain period. This is important because many users of the financial statements feel that the accrual accounting that's required under GAAP does not represent a true picture of the company's operations. We just touched on that on kind of the focus on why cash is important versus just income. Please note that the statement of cash flow is the only financial statement that is not based on accrual accounting. The statement of cash flow summarizes the operating, investing, and financing activities of the business. These are the three main types of activities that we're going to discuss in this class, and this is how the information is presented on the statement of cash flows. It is broken up into these three categories of activities. A few uses of the statement of cash flows. One is to assess the entity's ability to generate future cash flows. This is to understand the sources of future operations. Assessing their ability to pay dividends and meet obligations. So debt and dividends need to be paid in cash, and therefore you need to make sure that you're going to have enough cash to pay that. It reconciles the difference between net income and net cash flow from operating activities. We will discuss this more throughout the chapter, but essentially when you're calculating the net cash flow from operating activities under the indirect method, you will start with net income and then you will back out balances and add balances to get to the operating net cash flow balances. And then lastly, assessing the cash and non-cash investing and financing transactions during the period. At the end of your chapter, I have included 3 illustrations in this handout. One is to kind of break down some of the components of the statement of cash flows and what goes into operating, investing and financing and a few tips. The second one shows you how the cash flows for operating activities are presented under the indirect method and the direct method. And we will touch base on the difference between those two as we go throughout this chapter. And then another one is showing you under the indirect method the additions and the deductions from net income that the company will show to get to net cash flow from operating activities. To illustrate numbers, illustration 1 and 2 are very important. Make sure you understand those two illustrations, and I recommend using these as your guide as you're taking the quiz and completing your homework, as you will be asked questions on certain transactions and activities and which category they fit into, and possibly if it's increasing or decreasing a certain part of the cash flow. So it's very important to understand those two illustrations. Also to note, in illustration 2, there's a few caveats and important things to remember, and it kind of demonstrates as a reminder of when you will add and subtract balances from net income when you're working on operating activities under the indirect method. But we will touch base on those more throughout the chapter. I just wanted to give you kind of a brief introduction to those. So, classification of the cash flows. First, we're going to focus on operating activities. Operating activities are transactions related to the calculation of net income. These are basically all other transactions not classified as investing or financing, but these typically are normally operations and transactions related to everyday business purposes, such as salaries, rent expense, taxes, your selling and buying of, or your selling of inventory that may lead to your accounts receivable increasing, or you're paying cash so your accounts payable is increasing or decreasing. There are a couple what I'll refer to as oddballs when it comes to the operating category. There are a few items that, based on how their description, you would not think that they fit into operating activities, such as interest revenue received from other companies, interest expense paid on your own company notes and bonds, and dividend revenue received from other companies. These are transactions that are all classified as operating activities, despite them appearing to be investing or financing based on the descriptions of those activities. And as we get into the descriptions below for investing and financing, that will be a little bit more clear. But you can see that by the description themselves, they would possibly appear to fit into a different category. However, they are treated as an operating activity. Second, investing activities. These are transactions related to long-term assets and external investments. Think of this as investing in yourself. So for internal investments, when you buy and sell long-term producing assets such as buildings, land, natural resources, you are investing in yourself by buying these long-term assets that will be producing for you, such as the building. You get to use the building, and then when you're done using the building, you can sell it, and think of it as a long-term component. There are also external investments that fall into investing activities, and this is the making and collecting of loans, aka being the lender, as in I made a $100 loan to you and then you paid the $100 loan back to me. This is all on my loans, that I am the lender of those loans. And then also the buying and selling of debt and equity of other companies. That is a very important thing to remember. The key issue, and I would say the key thing that can be somewhat confusing between some of these categories, is the difference between if it's your company's activity, your stock, your debt, or it's someone else's stock and debt. So making sure you understand the difference between internal investments and external investments will be very key in understanding the statement of cash flows. Next, financing activities. These are transactions related to the liabilities and stockholders' equity of the company. With regards to debt, this relates to the borrowing side. So when you are borrowing and repaying debt from of others. So if you are borrowing money from company A and repaying money back to company A, that would be considered a financing activity. Think of it as student loans. When you pay student loans, you borrow from a company and you repay the company the principal back. So it is considered financing because for you to go to school, you need the money to pay for your tuition. So you are financing your education. Similar to think of it as a car payment. Please note though that this does not include interest expense paid on the debt, as this is classified as operating. But when it's focused specifically on the repayment of the principal part of the debt, it is known as a financing activity. So this is one of those oddballs coming into play here where you could be paying back your principal, for example, on your student loans, and that would be classified as a financing activity, but the interest expense that you pay on your student loans, that would be considered an operating activity. Regarding equity activities under financing, it's when you issue capital stock and you buy back your own common stock. So this is with regards to your equity, your securities. So you issue new common stock, or you buy back your common stock. It's your company's common stock. You are the one that is issuing it and buying it back. Whereas up above under investing, buying and selling equity investments of other companies, so someone else's stock, is investing. And then paying dividends is considered a financing activity, but please note that receiving dividends is considered a operating activity. So there's a lot of caveats and little things to make sure you understand between these three different activity types. Those illustrations definitely will help you at the end of the chapter, and they kind of summarize the transactions. When you are doing the quiz or your homework or an exam, you will not be asked to identify any type of transaction that does not fall within the information in those two illustrations. I used those illustrations heavily when I was putting together the assignments in the quiz and will be for the exam. So, as noted above, some cash flows relating to the investing or financing activities are classified as operating activities. Those examples include the receipt of investment income and payments of interest to lenders are classified as operating activities. Some cash flows relating to operating activities are also classified as not also classified. Rather than being classified as operating, they are classified as investing or financing instead. For example, the cash received from the sale of plant, property, and equipment at a gain, although reported in the income statement, is classified as an investing activity. However, the effect of the gain is not included in the net cash flow from operating activities. Likewise, a gain or loss on the payment of debt is generally part of the cash outflow related to the repayment of the principal amount borrowed and therefore is a financing activity. The preparation of the statement of cash flow. The sources of information that you will need. You will need comparative balance sheets, which means current year, prior information needs to be consistent and how it's being presented, the principles being applied, and so on. For the examples that you will be given to calculate the statement of cash flows, you'll either be given the total change in account balances or you will be given the beginning and ending balances for the account so you can calculate the change. You need the current income statement data. This will be your starting point when you're using the indirect method for net cash flows from operating activities. And then you'll need any other selected transaction data information of note, such as selling a building for a gain or a loss. The general format is you present operating, investing, and then financing. And then at the very end, after you calculate statement of cash flows, you will often see people present things called non-cash transactions. With regards to the operating cash flow, you need to make sure you remember this specifically. For this class, all sales will be on credit and all materials purchased are on credit. So accounts receivable and accounts payable. That is how you will think of how balances will be flowing through the cash flow statement, impacting both of these. So every example you have to do a problem on, you will see accounts receivable and accounts payable as something you need to reflect in your statement of cash flows. Very important to note, depreciation is not a cash flow. Similar to depreciation, amortization, these are called non-cash transactions that need to be adjusted when you're doing the statement of cash flows, and we will go through an example of that shortly. The steps to remember as you're completing, these are the high-level steps to complete. You'll do much more than this, but this is some things just to keep in mind. Determining the change in cash. One thing, when we get to an example, you'll see when you use the indirect method for net cash flows from operating activities and then you do investing activities and financing activities, the end result of cash flows will be the difference between what you started the year with and what you ended the year with in your cash balance. So essentially you're going to reconcile from net income to the cash that represents the difference between current year and prior year cash accounts. Second, you'll need to determine the net cash flow from operating activities. And then you'll need to third, determine the net cash flows from investing and financing activities. To compute the net cash flows from operating activities, it is necessary to report revenues and expenses on a cash basis. This is done by eliminating the effects of income statement transactions that did not result in a corresponding increase or decrease in cash. The conversion of accrual-based net income to net cash flow from operating activities may be done through either the direct or indirect method. The direct method, cash revenues and expenses are determined, and the difference between these two numbers represents the net cash flows from operating activities. This is the method that FASB actually prefers, but it is seldom used by company because under this method, FASB also requires a reconciliation of net income to net cash flow, which is how it is computed under the indirect method. So companies frequently will just complete the indirect method because instead of having to do two statements, they could do one. For purposes of this class, though, we will actually focus our attention on the indirect method since it is the most commonly used method for the statement of cash flows. Refer to illustration number 3 at the end of the handout for more details on the difference between the presentation of indirect and direct for operating cash flows. An example of the direct method would be you would start with what cash you collected and then back out the cash that went out the door, and that would end up giving you your result of net operating cash flow. One thing to note, the direct method presentation is similar to how you will present it for investing and financing activities. However, we will not do the direct method for the net cash flow from operating activities. but you will make sense of that when we do an example that financing investing, the presentation is similar to the direct method. For the indirect method, which is also known as the reconciliation method, this starts with net income and makes adjustments for items which affect net income but do not affect cash. This is very important right here. Your first thing you start with is net income. So you start with net income, and then you are going to make adjustments, either increasing or decreasing based on the type of activity that occurred, to get down to your net cash flows from operating activities. Refer to illustration 2 for some additions and deductions to net income under the indirect method. That is a very important illustration to understand, as most of the activities that you will have to reflect in the statement of cash flow or in any type of example identifying will likely be skewed towards operating activities because there are more things that fall within the scope of operating activities. Key information that you must understand in order to accurately complete the statement of cash flows. This first sentence here: write-downs, amortization charges, and similar book entries such as depreciation of plant assets represents neither an inflow nor an outflow of cash because they have no effect on cash. To the extent that they have been entered into the determination of net income, you must add them back or subtract them from net income. For purposes of this course, you will always add them back. So your first two steps and the easiest things to remember: if you start with net income, because net income reflects the expenses, if you had depreciation decreased your net income number. Therefore, you need to add it back because it is a non-cash transaction and it has no effect on cash. Therefore, since you're starting with a number that has it reflected, you need to back it out to get to a number that does not have depreciation reflected in the total. So your first two steps will be start with net income and immediately add back the depreciation that the company had for the year. The next few bullet points are detailed on the illustrations at the end of your chapter, specifically illustration number 2. When non-cash current asset accounts increase and the non-cash current liability accounts decrease, the change is subtracted from net income. So what this represents is if your accounts receivable increases or your accounts liability or your accounts payable, so the liability decreases, you need to subtract those changes from the net income that you start with as step number 1. What this represents, if your accounts receivable increases, therefore you did not receive cash for that balance. So you did not use cash for that balance, but it is something that you will receive cash for that balance. If your liability, so your accounts payable, decreases, that means you used cash to pay that liability. Therefore, you're decreasing the amount of cash that you have because you are paying it. The next bullet point is the exact opposite. So if your current asset account decreases or your current liability account increases, the change is added to net income. So in this example, for your accounts receivable, so the current asset, if it goes down, that means you collected cash. Therefore, it increases to the balance of net income. The most important thing to understand between these two is when to subtract and when to add. So before we finish this bullet point, I'll give you a rundown here of how this works for accounts receivable. So accounts receivable, going back to the previous bullet point. So if that account increases, that means you did not collect cash. this year. You may collect cash in the future, but right now you did not receive cash for whatever reason, because you sold revenue or you sold goods to people on credit. Therefore, your accounts receivable increase. Because you're not actually receiving the cash, you have to subtract this from the net income balance. This represents the fact that you are not receiving any of the cash. When the accounts receivable counts decreases, you will add this back to net income. This represents the fact that you collected the cash. Your accounts receivable decreased, and in order to do so, you had to collect cash from your customers. For the liability, so accounts payable, if it decreases, it represents that you paid cash to a vendor. You spent cash to lower that liability, that obligation that the company has. Therefore, it represents cash out the door, so it is subtracted from net income. For the accounts payable, when it increases, this is added to net income because this represents that you did not spend any cash while you still owe this amount to your creditors or your lenders. You did not actually use any cash during that period to pay off those balances. Therefore, you add it back to net income. Lastly, gains are subtracted and losses are added to net income in the statement of cash flow. This is done so under the net cash flow from operating activities section, and you will see in illustration number 2 when a gain or a loss decreases or increases the net income balance used in that section. As previously mentioned, the direct method is similar approaches used for financing and investing, and we'll talk about this more when we go through the Chapter 23 Excel file lecture handout and the comprehensive example that we will go through as well. Ultimately, there's some controversy around whether the indirect or direct method is better. The direct method has the advantage of showing the operating cash receipts and payments for the company, so what they're actually doing with their cash. The second is the indirect method has the advantage of reconciling net income with net cash flow from operating activities. So what this does is this shows how a company was able to generate income based on how they used their cash flows. Although FASB prefers the direct method, it permits the use of the indirect method. Special rules when applying these methods. These essentially just outlines the things that the companies are required to report when they're doing their statement of cash flows. We will focus on indirect, so receivables, inventories, and payables. These are 3 things that get for sure in every example you will need to account for in your statement of cash flows. Other things that you'll need to account for include depreciation, amortization possibly, interest expense paid, interest expense received, dividends paid, the issuance of common stock. Things of that nature are things you need to take into consideration when you're doing the statement of cash flows. And this last section just goes over some special problems. So this relates to some of those oddballs that we discussed earlier, but adjustments to net income that need to be made. For example, depreciation expense, you need to add it back. Any changes in deferred income taxes, they affect net income but have no effect on cash. You will not be required to know that for any exam, homework, or quiz. And if something gets on one of those with this deferred income tax part, you will be rewarded the points as long as you communicate that to me. Losses are added to net income and gains are deducted, similar to what we just previously mentioned. Other items that affect cash but not in net income include the purchase of short-term available for sale securities, short-term non-trade notes payable, and cash dividends payable. Significant non-cash transactions that are excluded from the body of the statement of cash flows. If they are material, they may be disclosed in a narrative or schedule at the bottom of the statement or as a separate note or schedule to the financial statement. So there may be material non-cash transactions that you would not reflect in the statement of cash flows, but they would need to be disclosed to provide more information to the investor. These are the three illustrations I was referring to throughout this lecture. And as you can see, it kind of highlights interest revenue received increases. And you can see this chart focuses on when it's other companies or is your company, the internal company. The sale from plant and equipment and bonds and stocks, you can see that the gain and losses reflect operating activities, but the cash flows appear here for the actual sale itself. So if I receive $100 from selling a plant asset, the $100 is going to be reflected in the investing activity, and any gain or loss from that is going to be reflected in the operating activities section. The second illustration, this is a very important one because this will show you how to calculate the net cash flow from operating activities. When a balance would increase, so as we talked about, you start with net income and you work your way down, adding and subtracting along the way. So this shows you items that are added to that net income balance and items that are deducted from that net income balance. So as we talked about earlier about a decrease in receivables represents an increase to the net cash flow from operating activities because you received cash in order for those receivables to decrease. This is a very important illustration to understand for all aspects of this chapter: quiz, homework, and exam. And the last illustration just shows you a presentation difference between direct and indirect. Direct method, this is similar to how you will present it for investing and financing activities, and when we get into the example we will go through that. So hopefully this chapter made sense. The main thing to note is there are the three different classification of cash flows: operating, investing, and financing. Hopefully the illustrations make it clear what type of transactions fall into each. Would definitely encourage you to refer to the textbook some throughout this chapter, as a little bit more explanation might be able to help you further understand the statement of cash flow and why things fall into certain categories. However, reminder, you are only responsible for the information on the lecture handouts, the exam or the homeworks, and the quizzes. So anything that's in the textbook that may not be in this lecture handout you will not be required to know for those assignments or for the exam. But using the textbook as a reference material for this chapter I think will come in handy, as there's a lot of good illustrations throughout the chapter on the presentation of the statement of cash flows and how certain balances are calculated. So the next lecture, and I will present this in a subsequent lecture, is we will walk through a comprehensive example of the statement of cash flows. And this example will be very similar to how it will be presented on your homework and also on the exam. Most of the items on this in the comprehensive example will be transactions that you will see on the exam and will need to account for in the statement of cash flows. There are things that maybe aren't presented in the example that you'll need to know. For example, we may cover the fact of a loss on the sale of a plant asset in the comprehensive example we cover in the lecture, but on the exam you may be required to account for a gain from a plant asset. But all examples of problems that you will need to make sure you understand how it increases or decreases the statement of cash flow are reflected in the illustrations at the end of this lecture handout packet. So if you can understand those changes and why, whether they increase or decrease, and why they increase or decrease, you should be okay, in good shape. I would also note that not only is it important to understand the computational aspects of the statement of cash flows for your homework, your quiz, and your exam, but the conceptual components in this chapter are very significant. Not only do you need to know that accounts receivable increases and decreases impact operating activities, but you need to know why the increases and decreases impact operating activities and how they impact it, whether they're added back or subtracted, and so forth. So it's very important to understand the conceptual components. That is all for today. I will work on putting together the next lecture going through the comprehensive example. That is the only thing we will cover in that next lecture. So the information from this lecture should allow you to complete most of your homework, I believe all of your quiz, and then once we go through the comprehensive example, you'll be able to complete the last main component of the homework. Your quiz and your homeworks are posted to the web page right now, and you can start working on those prior to the example, comprehensive example, that if you review that. But I will also be providing the comprehensive example lecture shortly. In addition, I am working on creating some additional statement of cash flows problems that you can use as you prepare for the third exam. That is all I have for today, and I look forward to presenting the next lecture on the comprehensive example for the statement of cash flows, and then seeing everyone again for the third exam. Have a great day. Bye.